Welcome back to the Armchair Trader podcast, and today we're talking about microcaps. On the podcast with us, we have George Ensor, who is the manager of the River and Mercantile Microcap Fund. Welcome to the podcast, George.
Hello, thank you very much for having me, Stuart.
So you're actually the first fund manager we've had on the podcast who specialises in this market, but it is a market that a lot of our readers are actually really interested in. So it's great to get some insight from a professional in the space on the dynamics of this particular market.
It's a fascinating space.
Just to kick off, can you give us a quick summary of the microcap fund, the River and Mercantile Microcap Fund?
Absolutely. So as you've kind of just said there, what we're trying to achieve is accessing a part of the market which is typically inaccessible to institutional capital. So we are looking to invest in a portfolio of about 40 stocks, so quite high conviction in companies, UK listed companies with a market cap of less than 100 million. So that's very difficult to do in a large institutional mandate. That's why we need to be in our closed-ended structure. And we think that by doing so, by looking at that part of the market, which is often overlooked, we are finding companies which perhaps there's less competition to find, there's less competition for those assets, and so we can get better opportunities. And also the sell side coverage is much, much lower. And so we can exploit those inefficiencies in high quality, high growth or turnaround stories not being particularly well covered in the market.
And the closed-ended structure, by that, for those who are not familiar with it, you're talking here about a listed investment trust that's listed on the London market.
Yeah, absolutely. So we've got a investment trust that trades on the market. So our shares trade at a discount or a premium sometimes to our net asset value, and that means we don't need to think about daily trading units. So we're not. We have a massive mismatch between the liquidity profile of we would if we were in an open-ended typical UCITS fund, have a very large mismatch between the liquidity of our investments and the liquidity that we would need to offer our clients. And so we're in that closed-ended structure. The closed-ended structure actually enables us to do something else, which is a key kind of attribute of the trust, which is we've always said, because we're trying to invest with conviction in sub 100 million market cap stocks, that when we've got too much capital, we will return that capital to shareholders. And so we have returned 77 million over the last 5 years or so to shareholders. We originally started with 70 million, so we've returned all of the IPO proceeds to shareholders. And you wouldn't be able to do that. You wouldn't be able to control the size of your fund if it was a conventional open-ended UCITS fund. And so that closed-ended structure enables us to manage the capacity and make sure that we're not trying to run too much capital in microcaps.
And before we go any further, can you provide a definition of what you regard as a microcap for the purposes of the fund?
Yeah, so we are looking to deploy capital between a free float market cap of 20 and 100 million. So these are very small listed companies. They're all listed. We don't look at unlisted companies. That is a different skill set. So there are about 450 companies in the UK, remarkably, that sit in that part of the market. And we screen that, and we're looking to own approximately 10% of them. Now we are never a forced seller. So what we're looking to do, a key kind of aspect of the trust, is finding relatively early stage growth businesses that again, the institutional capital might not be able to invest in because they're too small. And owning those, compounding high growth or high return on capital, or preferably both. And as those businesses compound that revenue growth and capital return, they grow. The businesses become larger, their P&Ls become larger, but also they go through those market cap thresholds, which make them more investable to the larger institutional small cap sector. And so we tend to see, as these businesses go through maybe 100 million market cap, 200 million market cap, 250 million market cap, we see them becoming more investable. And so you get a re-rating of those shares, particularly if there's still a very clear runway of growth to go for in the future. And so if I was just to use a stock example of why we do what we do and how it can be very rewarding, We invested in an IPO in November 2017. It's a business called Keystone Law. You might have heard of it. Your listeners might well have heard of it. It's a fantastic business. They are a platform for lawyers. So if you're a lawyer and you bill in excess of £500,000 of revenue, you can move from your current firm, pending being interviewed and them accepting you into their firm. You can move over to that firm and you will take home 75% of your billings. So that will be a big improvement on what you would have been paid as a senior lawyer at a law firm prior to joining Keystone. And they provide all the services that you would need, offices to do client engagements, paralegal support. They offer you the brands to operate under, but you're in charge of your own business. And that business IPO'd November 2017. The market cap when it IPO'd was 50 million, 50. So quite difficult for most funds to access that. But the capital they offered to the markets, the free float was 15 million, 15. So that's a very, very small business. Now it's gone from that 50 million market cap to about 150 million market cap. It's also returned about 25 million of capital through dividends and special dividends. So we've made a 250% return on that investment to where we are today. Remarkably, the business, the market, the small cap market since November 2017 is actually about flat. I think it's up 1 or 2%. So that's where we are in the cycle. Small cap stocks in general have seen a massive derating, and actually Keystone Law has seen a big derating as well. It's compounded profit growth much higher than actually the market has returned, the equity return of that business. So you will find small cap funds that might have a position in Keystone Law, but they'll have to have quite a small position because the liquidity profile of it is challenging. You're probably not going to find a portfolio of those kind of businesses. And so we think if you can build a high conviction portfolio, and we've got about 75% of our NAV, of the assets in our fund, are invested in our top 20 positions. So if we can find 20 to 40, but there's some coming in, some coming out, of those kind of businesses that we can own going up through those market cap thresholds and let the market re-rate them as they deliver, then we can create lots of value for our shareholders. Returning excess capital when we've got it, and then kind of hunkering down at this stage of the cycle and trying to deliver some good performance, which is hard, but obviously not having that risk of redemptions that you see in the open-ended sector. So that's kind of what has happened since we IPO'd and where we are now. And if we go right the way back to IPO, our NAV's up about 82% since then. Shares have underperformed that because we've got a discount. The small cap benchmark is up 48%. So we have created lots of value in excess of the benchmark return.
And what happens with companies that you're holding that actually become more successful and bigger, and they no longer fit that MicroCap template that you've got? Basically, they get the market cap goes up 200 million. Do you hang on to them, or are you forced to exit the trade?
So it's really important we hang on to those until we think that realization of it becoming a conventional small cap stock has finished. So we own stocks where we think there's a big margin of safety on valuation between what we think they're worth and what the market's valuing them at. But when these stocks start to re-rate in the market because they come onto the small cap universe, it's very important that we actually run them as momentum stocks. And we're looking for earnings momentum and technical momentum, because there are some large small cap funds out there. And if they decide to put 0.5% of their portfolio into a 150 million market cap stock, that is going to drive significant buying demand. And so it is very important we continue to run those winners. So our portfolio weighted market cap is about 120 million, so above that 100, but we've got businesses in there that we've bought lower and have outperformed, and the larger positions in the portfolio tend to be the more successful ones, which have obviously gone up through the 100 million market cap threshold. But we've actually got stocks in there that we've run to much larger market caps. We've actually got an 800 million market cap stock in there still. It's a fintech business called Alpha International, used to be called Alpha FX. So we will continue to run those winners until we find a higher conviction microcap stock that we can recycle those assets into. And in a way, that's been hard recently because there haven't been IPOs and placings, which is normally something that we use to deploy capital. On the flip side, you've had quite a lot of companies coming down from being small caps to micro caps. And so that's provided us with some opportunities to perhaps pick up liquidity where some of those small cap funds want out of their micro caps, and we can trade into them at a discount.
And when you're looking at these companies, you mentioned earlier on that they're not very well covered. I mean, I'm assuming that with some of them, that nobody's actually done any independent research on them at all, and that therefore the onus is on you guys to go in and make your own decisions without any kind of external research overlay there.
So you're right to flag the independence of research, because almost all of them have a broker, a nomad, who will write research, but it will tend to be a couple of pages focusing on the positives. Let's put it that way. There are very few microcaps with more than one broker covering them. Again, going back to that point about companies going up through the market caps and getting re-rated, that's when you tend to see more brokers coming on to the coverage. And so they are often coming on to try and pick up the brokership, and that often acts as a catalyst for the shares to go onto more radars and be reviewed by more managers. So we actually have a quant system we use for idea generation. So that's how we filter those 450 stocks down to the ones that we want to spend a bit of time reviewing, and then obviously building models, going along, seeing management teams, but trying to make sure that we're quite efficient with the ones that we take all the way forward to do the full work on.
Are you seeing a lot of value opportunities in this space at the moment, more than usual?
So the small caps are extremely cheap. So everyone's very, it's very clear how cheap the UK market is, particularly when you compare the UK market to the US. The US is expensive, even if you take out the big tech stocks at the top. It's still pretty fully valued. The UK is exceptionally cheap. People are very bearish on the UK, and sentiment towards the UK is very poor. What I think is pretty remarkable is the lack of small cap performance we've seen, well, particularly over the last 2 years. So in the last 2 years, small caps have underperformed large caps by 36%. So that you have to go back to 1989 to find a greater period of underperformance. And what that's meant is you have to go back 10 years for the UK to have a small cap premium. So typically, and one of the attributes we're trying to exploit is that small caps grow quicker. They tend to do more accretive M&A. And so you get what's called the small cap premium, or the growth premium, or the liquidity premium, which is the 3 to 4% per annum that small caps have historically outperformed by. And we did see that. We saw that coming out of 2009. It's very pro-cyclical. So when sentiment is high and GDP growth is good, and fund managers are getting inflows, the liquidity premium tends to be a bit wider than that 3 to 4%, i.e. small caps outperform by more. When times are tough, and we've had 24 consecutive months of outflows from UK small cap funds, it tends to go into reverse. But the extent of the reversal that we've seen over the last 2 years is not quite unprecedented, because you can go back to 1989 and it was 39%, but it is very extreme. So I think the opportunity in small caps is kind of once in a 10-year opportunity. And if you look, there's loads of different ways, obviously, to think about valuation. But if you just look at PE, the UK small cap market trades on about 8 or 9 times at the moment. On the 1st of January 2009, it traded on 6 times. So it was a little bit cheaper coming out of the financial crisis. But the ratio of small cap to large cap valuations is actually cheaper now. So in 1st of January 2009, small caps traded at 86% of large caps ratings. We're currently at about 65%. So again, there's this big divide between large cap valuations and small cap valuations. So we haven't had a small cap premium in the UK for 10 years. I think that sets up an opportunity like we saw coming out of 09, where you got the performance of smaller companies from March 09 to September 21 was about 450%. It was double the return of large caps. And I think we're setting ourselves up for that kind of opportunity going forwards. And if we get that, the Microcap Trust is extremely well placed to benefit from that, because it's the bottom end of the market which has been hardest hit by what's happened. And to bring in our more recent performance, our NAV is about 40% lower than it was in the middle of 2021. So we have experienced that kind of aversion to illiquidity that you can see in the market.
And just going back to risk, obviously there are many investors in the UK who are familiar with what can go wrong when fund managers are invested in highly liquid micro-cap stocks. Can you just say a little bit more about how you manage the risk around the fact that you're actually investing in as a fund manager in stocks that are highly illiquid and can be difficult to exit if you need to quickly?
Yeah, so I guess the challenge there is if you need to exit quickly, which one you can never guarantee, and two, if the fundamentals of that business or the sentiment in the market have changed, you go from a position where you might have been able to do that to not being able to do that. And so I think the way we think about risk is to not kind of overlap that illiquidity, which is what we're trying to exploit and which is where our returns have really come from over the years, with either leverage or too much risk on a stock specific basis. And so by that I mean, don't invest in too many loss makers. We want to invest in early stage growth businesses. We don't want to exclude businesses that happen to be loss making because they're going through trough margins. But we don't want to have a portfolio of loss-making companies which might ring us up and say, look, we're going to run out of cash in 6 months if you don't bail us out. So we've got less than 5% of the portfolio. It's actually closer to 2.5% of the portfolio in loss-making stocks. So we're predominantly invested in profitable businesses. We don't want too much leverage in our businesses. Again, we're exploiting that liquidity premium. So stay away from businesses that are too highly geared. About 60% of our fund is net cash. Of the balance, about half of it, those businesses have very strong asset backing. So we own a pubs business, and they own a large proportion of their pubs are freehold. We own some mining businesses that have got large reserves to support a level of leverage. We still don't want too much leverage in those businesses. But the most important point is that we never have to sell if we don't need to, because we've got that closed-ended structure. And the one thing just to add on our capital return mechanism, so this mechanism that we return capital to shareholders when the fund gets too large, it's a very pro-cyclical mechanism, because our trust has to be growing and we have to be going up through. We've stated always that we will return capital between 110 million and 125 or 30, I can't remember, million of net assets. And so clearly for us to get there from here, where we're at about 60, 65, we would need to see tremendous growth in our portfolio companies. But we have been here before. We've been at a similar net asset value. I think it would have been in 2018 or 2019. And we returned 35 million in 2021. But 2021 was a fantastic time to be raising cash from our portfolio, because everyone loved owning small caps and they were being bid for. And there was, significant outperformance of microcaps. I think we outperformed quite a strong small cap benchmark through 2020 and 2021 by about 25-30%. So again, we never have to sell a company because it gets too large, and we only need to raise capital from the portfolio when we've delivered some strong performance, which you'll typically find is when other people are looking at these assets as well. So I think that we have diversification in the portfolio as well. Of course, we've got 40 stocks, although we are quite concentrated in the top 10. But it's really that closed-ended structure that protects us from having to try and raise assets too quickly.
Gotcha. And do you have a set sort of maximum tolerant for debt with companies you'll look at?
Look, I think we need to be very cautious. We don't, and we tend not to have any hard and fast rules like that, because as soon as you have hard and fast rules like that, there are going to be opportunities on the other side where you might have a fantastic opportunity. But in general terms, you really don't want to have loss-making companies which are reliant on debt funding, because you will get a phone call and the equity placing won't be done at an attractive level. We can go out with that. You're going to get some wrong, and they're probably going to end up in that position. And so you've got a decision to make as to whether or not you back them and believe they can turn around the P&L, or if you walk away and obviously experience some significant capital loss. But in general, we want to stay away from loss-making businesses that rely on debt. And for the loss-making businesses we do have, so one of the loss-making businesses we have at the moment, it has 40% of its market cap in cash. It could fund its existing losses for 3 or 4 years, probably even more. So, we're very comfortable on the ability for that business to get to break even before it comes anywhere near close to running out of capital. So no, look, you very rarely see more than 2 times leverage. But we've got a business that has fixed debt. It's fixed its debt at very attractive levels. It's got very high margins. So we can be comfortable with that business having a high level of debt.
In terms of, I want to mention the B word, Brexit. Have you seen any impact on this microcap market from Brexit itself? I know of some other fund managers who have deliberately sort of trimmed their portfolios for companies that had too much exposure to European trade, for example, because they anticipated it wouldn't necessarily do as well going forward.
Yeah, I think not specifically. There obviously have been examples. I think the microcaps have been far more impacted by the general sentiment towards the UK, and I wouldn't put that down specifically to Brexit, but Brexit did cause a lack of investment in the UK. We've then gone through, I guess, several prime ministers who have been quite high profile and have made quite a lot of noise, and that has undermined the willingness for people to invest in the UK, to hire people, to put capex down. And I think we've definitely seen that recover in the last 6 months, maybe. So actually, when we think about the UK corporates are pretty cashed up and are investing. UK consumers have a very strong balance sheet. They've just gone back into real wage growth, which is a clear positive. The headwind to consumers is obviously around interest costs. It'll take a few years to fully impact, but mortgage costs are going to be eating away at discretionary spending over the next few years. But I think it's more around the overall impact to risk sentiment and people being willing to invest in smaller companies. That's a much more important driver. There are odd examples of companies which have kind of tripped up, with logistics going cross-border. But they're few and far between, I think, really. So Brexit's not a massive issue. Risk sentiment and probably access to growth capital. So, we've seen capital markets close now for certainly 18 months, if not a bit longer. And there are growth businesses out there who I'm sure would like to go to the market, raise capital to execute acquisitions and to accelerate growth. But they don't want to put their head above the parapet if they don't think they're going to get the placing away. And so you get into this kind of standoff where nothing happens. And that's not great for innovation or investment or growth in general.
Being topical here, do you think that the recent ARM IPO might have a kind of knock-on effect on sentiment here in the UK and get people a little bit more bullish about listing?
Look, it can't be unhelpful. I think it would have been more helpful if it had happened in the UK. But I think we're starting to see M&A return, definitely, and that's helpful. I think we could well see that escalate into the back end of the year because the valuation gap between US companies and UK small caps is just massive. And actually, we've got a bid in the portfolio at the moment, which is a kind of life sciences software business in STEM that got bid for a couple of weeks ago or a month ago. So we're starting to see that come through, and I think that will drive a bit more interest. But I think you really need inflows back into UK assets and back into small cap funds, because I'm sure the brokers are ringing around the portfolio managers and saying, look, if we brought something around at the moment, would you be able to invest in it? And they probably say, to be honest, I've got like 10 stocks in my portfolio I'd love to put capital into at the moment, but I don't have any cash in my portfolio, and I'm trying to manage outflows. And if we think back to the last set of IPOs that came out in the UK, they've had a pretty tough time. not Microcaps, but Trustpilot had numbers this morning starting to recover, but a long way below its IPO price. Moonpig had a trading update this morning, another IPO from a few years ago, which has had a tough time. So I think, we need to see some recovery in the market before that kind of capital markets properly reopen in the UK.
And if you look at the microcap universe, are there any particular sectors that you really favor? I know you're not necessarily a sector-driven investor, but I mean, is there anything that looks like a standout area for you?
Yeah, so yeah, you're right. We're not sector driven, but there are some clear opportunities. I think tech has had a really tough time. So lots of tech businesses, are investing. They're trying to build that, high quality recurring revenue that investors do like. But they've had quite a tough time. A lot of them are break even or loss making, and those businesses have massively underperformed. So there's some exceptionally cheap tech businesses out there, be it outright tech. FinTech has also got some, fantastic growth. Prop tech is somewhere, health tech and property tech are two other kind of subsectors of technology where I think it's very interesting. We've got a big overweight in healthcare, and that's mainly through kind of technology plays on healthcare. And financials are really interesting. In microcap, you really need sectors where you don't need loads of capital. So technology is a good example where you don't need to put down a load of capital to be able to generate a business that can grow and make attractive return on capital. There are some capital-light financials as well, although probably fewer between. The sectors we need to kind of stay away from are where scale is a really important enabler of a business and the returns that business can make. So there are some fantastic industrials in the UK, but they've got large capital bases. They're big businesses, and the size of those businesses is critical to them being able to invest and innovate. And so if you're looking sub 100 million, you're probably not going to find too many of those. There are a few. We've got a couple of industrials. So it's more us trying to focus in on where we can make a return or where the fundamentals can work on low levels of capital, because that we obviously in microcaps you don't have loads of capital.
And what does your ideal microcap stock look like at the moment? What are the characteristics that would really get you excited for a company?
Yeah, so we think about three things when we're trying to buy a company. So is there really clear shareholder value creation? And for shareholder value creation, we think about either growth, so rapid revenue and profit growth, return on capital, or a combination of revenue, of growth and return on capital, and then turnaround stocks, businesses that have got either very depressed asset backing value or depressed margins. So we're kind of thinking about a company life cycle. Businesses start off of growth businesses. They can generate high growth. As they mature, they tend to become more quality, so the higher return on capital, high and improving return on capital. And then you can pick up businesses after a decline phase where you are betting that the business can go back to the franchise it has been historically. And if you're right, you can kind of get that combination of cheap multiple on the way in and rapid margin improvement. So with that, we're trying to put capital into those three kind of categories, and we've got a bias to growth, understandably, given what part of the market we're investing in. So we're about 50% growth, and then the split of the balance is between the quality and recovery stocks. So we're looking for that clear shareholder value creation. And then we're looking for a mispricing. That's our valuation discipline. And then we're looking for momentum. So we're looking to kind of maximize our ownership of those businesses when they've got improving technical and earnings momentum. And I touched on that earlier in terms of running our winners and making sure we don't sell out too early if you've got businesses that are getting upgraded and have got buyers going after them. So the business I mentioned earlier, the lawyer platform, is a fantastic example of something that kind of ticks two of those boxes, because it's got growth. The business has delivered fantastic revenue growth, I think 25% organic revenue growth over the last 8 years per annum. It's delivered margin improvements. So the profit growth has actually been more like 33%, all organic over the last 8 years. So that would put it, I don't know, top 10% of businesses in the UK in terms of the growth attributes of that business. But then if you look at the cash flow statement, they require very little capital. They had 50 grand of capex on 6.5 million of operating cash flow. They paid some tax. Everything else they've basically paid back to shareholders. The balance sheet has some goodwill on it, a little bit of working capital, and some cash. So the incremental return on capital as they grow is extremely high. So that's a fantastic business in terms of high growth and high return on capital. The business trades on about 15 times. That might look quite punchy versus a market which trades on 9, but it generates a lot of cash. And actually, the shares are currently for £4.50, £5. A couple of years ago, those shares were trading at £9. And that's a massive derating, but it was trading on 45 times earnings at that stage. So the market got ahead of itself. We could see that at the time. We did take some capital out of the name. We added back to it recently below £4 because the market's just gone totally the wrong way. And that's the sentiment cycle that plays out, particularly in small caps. The business, remarkably, has basically just delivered to expectations or upgraded pretty much since IPO. So 2017 IPO, they downgraded numbers in 2020 for COVID. But actually COVID ended up being an enabler for the business because it showed people that working from home is actually quite liberating and quite enjoyable. And their model works on people working from home. So it ended up accelerating the growth of the business. But there was a short-term check in that. But if you go back and look at the shares, they've gone between 160 and £9 over the last 7 years. And so, as listed investors, we need to be active and we need to try and exploit that sentiment in the market as well.
Would you say that's your favorite stock in the fund right now? You sound pretty enthusiastic about it, or is there one that even outshines that?
I mean, it's recent because they had numbers recently and they upgraded, and there's not loads of upgrades going around at the moment, so it's top of my mind. We've got another. I mentioned tech being quite an interesting space. We've got a relatively early stage growth business. It's enterprise software business. So the business is called ActiveOps. They deliver productivity software to banks, healthcare businesses with big global back offices. So their pitch to these businesses will give you a 15% improvement on your productivity of your back office. So an environment where wages are going up, that productivity improvement gets better. And the way they do that is providing data to management teams to make sure that they're maximizing the capacity of all of their globally distributed teams. So that was an IPO, one of the IPOs from 2021. We participated at that stage, but it came on 5 times sales. So everyone likes to beat up the UK at the moment and say that we don't have a market where growth can be recognized, but 5 times sales is quite a full multiple. We bought in relatively small position at that stage. The business more than halved. It's currently sitting at about a 50% discount to that IPO price. They've delivered expectations. The market doesn't like it because it sees it as a loss-making tech startup, but actually the business has been free cash flow positive for the last 6 years. They've just gone into P&L profitability on their P&L, which should help drive a re-rating. And that's one, again, that we took the opportunity to kind of build our stake as some of the small cap funds decided to exit post the IPO. So we built our stake in that over the last year.
It's strange how you can see those misconceptions in the market, isn't it? Particularly in microcaps, but you see it even in bigger companies where there's just this sort of preconceived idea, and you see investors talking about it on forums as well, about a particular stock, which is completely wrong. But that's wrong there's enough people sharing that view that it can actually depress the share price quite significantly.
Yeah, and I think that's why it's so important to not have a load of rules. And you say, well, I won't invest in anything that's free cash flow negative or P&L loss making, or I won't invest in anything that's got more than 2 times net debt. Because as soon as you do, you're excluding yourself from being open-minded to those opportunities. So you could invest in a business that's got 2 times net debt to EBITDA, but it owns a load of freehold assets which haven't been revalued for 5 years. And you can make a sensible assumption that the freehold backing is probably worth more than it is on the balance sheet. So that's why we have a concentrated fund, because you want to really dig into these and make sure that you've got conviction. But ActiveOps has probably slightly disappointed on top line growth. It hasn't missed expectations, but it's done kind of low double-digit top line growth. And the expectation set from the market, from the buy side, was probably that they were going to see faster acceleration. But the business has been through COVID, and going out with a direct sales force to big banks and healthcare businesses it's quite a hard sell when you're trying to manage COVID and people working from home. I think the backdrop for them now is fantastic because companies are looking to cut costs. They're trying to maximize productivity of the people they do employ. And clearly AI is going to be a big enabler of that. And this is a tech business that manages the productivity of employees, and they've already come out with a couple of AI modules to kind of boost their proposition. Now, AI has been a massive driver of performance in the market this year, the haves and the have-nots. No one really cares going down as low as kind of businesses that have got the market cap of active ops. But it will be a massive AI winner. It hasn't shown that in the re-rating yet. Again, it's very strong. So that's a business. It's been free cash flow positive. P&L's been loss making. It's got 25% of the market cap in cash. So we don't have any concerns about that business needing additional funding.
And really, my last question relates to mining companies, because we have a lot of readers who are in mining stocks. There's a lot of them in the microcap space. There seem to be a lot of really good stories out there that have just been relentlessly sold into the floor in the last 24 months.
Yeah.
What's your view of the mining sector, and is that ever going to make it back?
I think it will make it back, because I think whenever there's a view that something's never going to make it back, one of the conversations I have with clients at the moment is, will small caps ever outperform large caps again? And to me, that seems like a very obvious thing that it will, but I can sympathize with people who have been the wrong side of that trade for the last couple of years, thinking, when's this going to end? So I think whenever you get that very bearish sentiment, negative kind of positioning, it probably sets up the next couple of years for those stocks being quite interesting. The backdrop to this is CapEx for mining, be it precious metals or the wider commodities, including oil, actually, has been extremely low. So people have not been investing in new developments, and that will result in us having deficits on some commodities, and not actually a microcap. I also manage a small cap fund. We've just bought a Spanish copper miner, Atalaya Mining, in our small cap fund. We think the outlook for copper is quite interesting. It's a cheap business. It's growing its production. It actually owns the original Rio Tinto copper mine in Spain. In the microcap trust, we've got Shanta Gold. So we quite like gold. We think that's a well-managed business. Again, growing its production, growing its free cash. There is a bit of leverage in that one at the moment, but they should be able to pay that off pretty quickly with gold at $1,900. We owned Sylvania Platinum for a while. We exited that quite well, but we made good returns on that one. You do have to always be very conservative with the metal price or the commodity price that you base your assumptions on, because we know these businesses, the commodities can often, go to very depressed levels. And I think part of the challenge specifically in microcaps is it is a bit of a scale kind of industry. So the lowest cost producers aren't always going to be, but they're often going to be those big assets which can have low, better capital efficiency and lower costs. And you want to be in the bottom half of the cost profile if you want to stay away from the really risky assets. So that's one point. The second point is you often get single geography, single asset companies in microcap, and clearly that just comes with a lot of risk. Anything can happen to those single sites. They can underperform for 6 months, and then you get the momentum going against you, or you can have a coup, or you can have a challenge with tax with the local government. There's loads of things that always happen to these, but when it's your only asset, it makes a much bigger impact. And I just think over the last, with the exception of maybe a year, over the last 5 years, risk sentiment in the market's been very poor. And so those kind of businesses that are dependent on growth capital and risk sentiment have really struggled.
I know I said that was my last question, but I just want to ask you one other thing before we let you go. I know we're running out of time. Do you ever look at the shareholding of a microcap, at the breakdown between institutional retail shareholders, and are there some companies where you might feel they're too retail? I'm not going to mention any names, but I know somewhere it's like massive bias towards the retail market, and it's quite hot because it's become one of those really hot names on the market.
Yeah, so absolutely, we have to look at shareholder registers. That's really important for us to understand one, how are we going to get in? Two, how are we going to get out if we do make the return that we want to make? But also, you don't want to buy into a company where you can see there's a big overhang. Management might have exited and still own stock, or founders exited might still own stock. You don't want it to be too concentrated, but you do want to have high quality institutions in there. You also actually want some retail, because retail absolutely helps the liquidity, and we do want to be able to trade the names we've got. So you don't want registers that are absent of retail, but we need to be cautious of capital coming in and out very quickly, which tends to be those more retail driven stocks. So there are examples of them. We've probably got a few of them. We try not to have too many of them, because they can, we want to, they can re-rate exponentially, and then they can fall quite quickly. So we need to be quite careful of that as well. But the shareholder register analysis is a part of our kind of analysis. Yeah.
Fantastic. Well, thank you very much indeed for your time today, George. That's been really insightful and shedding a little bit more light on the UK microcap market for us. You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.